Hello, I hope this finds you well. Today is Friday, May 26, 2017, and in about 4 minutes, I will share with you a brief overview of the markets last month, and I'm going to share some thoughts on the current state of the housing market here in the US. Stocks added to year-to-date gains in April as the S&P 500 returned 1% for the month, bringing the total 2017 return to 7.2%. On a total return basis, April's gains marked the sixth straight positive month. Gains were primarily driven by the favorable outcome of the first round of the French election and a very strong start to earnings season. Markets have been incredibly resilient in general, able to shrug off some soft economic data that we've gotten, as well as increasing skepticism in the Trump administration's ability to achieve its pro-growth agenda, not to mention escalating conflicts with North Korea and Syria. International stock markets produced solid gains in April as both the MSCI EAFE index, which is developed international stocks, and MSCI Emerging Markets Index both outperformed the S&P 500 with US-based dollar returns of 2.6% and 2.2% respectively. Both indices actually remain ahead of the S&P 500 on a year-to-date basis. In the bond market, Treasury yields fell across most maturities in April, leading to a very positive month for bonds overall. The broad Bloomberg Barclays Aggregate Bond Index returned 0.8% for the month. For the remaining 2 minutes or so, I want to provide a quick update on the state of the housing market here in the US. You know, housing is incredibly important part of our US economy. It accounts for approximately 15% of gross domestic product, or GDP, if you include money spent on construction, maintenance, and rent, including owner imputed rent, which is essentially the rent you would pay to live in the house that you own. Home equity also accounts for approximately 15% of the average household's net worth. Housing prices surpassed the all-time levels reached 10 years ago in November of 2015 and have been moving higher since. But it is important to remember that the market is very different today than it was a decade ago for a few reasons. First, as you can see in this chart, even though prices have increased, home affordability is high relative to historical levels, thanks to low mortgage rates. The opposite was true in 2007. By the way, housing affordability is the ability of a household with median income to afford the payments on a median-priced home at current mortgage rates. Second, overbuilding, which emerged 5 years before the Great Recession, is a trend that is not present today. This chart shows the cumulative difference between growth in housing stock and housing formation. As you can see, the number of households formed has increased by more than housing stock has during this cycle. The last factor I want to bring up that's about to hit the housing market is the next demographic wave. The millennials are about to enter their peak housing consumption years, which historically happens around 31 years old. Now, despite the popular perception of millennials living in their parents' basements forever, there are more than 80 million people in this demographic group, and the reality is eventually they will require housing. So a few reasons to keep in mind why this current housing market is not experiencing at all the same excesses that contributed to the crash in 2008. Thank you for taking the time to watch this, and as always, if you have any questions, please feel free to reach out. Take care.